one of them, there's a 70% chance that at least one or the other will end up in a long-term care facility. Long-term care or long-term care riders, and basically long-term care is a form of insurance. The insurance license that is required to do long-term care is a health insurance license, but a lot of the time, and depending on the state you live in, there is no such thing as just a health license. Sometimes you have to get a life and health license in order to be able to offer long-term care products. I am in the state of Utah, and in the state of Utah, you can do life and you can do health, and you can do them separately. You can do, life first and health later, health first, and so, there's a little bit more flexibility there. But basically, long-term care, one of the biggest mistakes that I hear is that long-term care is only for old people. Long-term care is meant for old people only, but then the mistake is if you wait until you're old to get long-term care coverage or riders or supplements or whatever, it's significantly older. It's significantly more money. Okay, and why is that? Well, just a general concept of insurance is if this is my death day right here, and this is today. The question is when is this death day? And really there's no way to know that. Nobody has a crystal ball. And so what insurance actuaries do is they use actuarial math, and I explained that in a different class earlier, just on general insurance terms. But what they're looking at is if this is the day of somebody's death, the question is how big is this space between today and when they pass away? Well, because we don't know that, the only thing we can do is guesstimate based on other people's age and other people's life experience with the different conditions, health conditions that they have, is how long this typically is for somebody this age. So, for example, I am 35 years old as of just a few days ago. So I'm 35 years old. In general terms, if I'm in good health, how big is this gap? It might be 60 years. That's kind of weird to think about. But this is 60 years away potentially. So do they need to charge me a whole bunch to fill the gap of insurance? Because what's the gap of insurance is here's what the cost of the coverage or the need for insurance, what the need might be for insurance, and here's what I can reasonably pay so that, one, the insurance company can stay in business, but two, I can pay enough into the pool over here, as my money goes in and other people's money goes into this pool, that this pool is getting filled up with enough so that if something were to happen to me, that this money can fill in the gap of the cost of what I'm paying compared to what it actually costs. And so if I wait till I'm 50, statistically and potentially health-wise, I'm closer to my death date when I'm 50 than I am when I'm 35. So when I get to age 50, I have to put more into the pool because the chances are I'm closer to death than a 35-year-old. Now, what's funny about insurance, whether it's life insurance, car insurance, homeowners insurance, any type of insurance, it's basically a bet with the insurance company. You're betting. Your bet is called your premium. That's your bet. And the insurance company's bet is called coverage. So you're betting the insurance company, hey, insurance company, I bet you $250 a month that I will need long-term care in the next 60 years. And then the insurance company says, well, we bet you $500,000 worth of long-term care or $7,000 a month in a long-term care benefit that you won't need it. And so that's our bet. But then we're both getting something. Initially, they're getting the premiums, but then if something happens, we win the bet and we get the benefit, right? So statistically, though, if we're looking at long-term care insurance, there's actually, this is what's crazy, it's a 70% chance, you have more than a 70% chance, married couple, so here's a husband, here's a wife, a husband and wife, one of them, there's a 70% chance that at least one or the other will end up in a long-term care facility at some point of their life. 70% chance. So, you look at insurances, and it's because of the bet, we want to make calculated bets are a little bit better than just, random bets we don't know anything about. And so the chances of dying are 100%. So life insurance might be a good one to have. The chances of ending up in long-term care are 70%. That's a pretty good one. Are the chances of getting in a car accident, are those high or low? Chances of having a health condition in your life, those are really high. Maybe that's why that one's required, right? And so those are the statistics. So is long-term care important? Definitely. It's definitely an important factor when looking at your overall financial well-being. So long-term care, or LTC coverage, is a type of coverage that can either be what's called standalone long-term care, or it can be added as a rider to a policy. If you want to learn more about riders, you can go to class number 27 to learn a little bit more about what a rider is. But it can be a rider that's added to another policy. And actually what's interesting is if you look up long-term care coverage on the Social Security Administration's website, which is ssa.gov, SSA, as in Social Security Administration.gov, it actually lets people that are applying for Social Security and looking at those benefits and things, that the least expensive, typically, again, there's going to be variations, but typically the least expensive way to get long-term care coverage is as a rider on a life insurance policy. Again, if there's an insurable need there, they can afford the life insurance, they qualify to it. So in order to get long-term care, whether it's a rider or it's a standalone long-term care coverage, either way, there's a qualification process. The qualification process allows the actuaries to do the math that they need to do as they're calculating the distance that they think you have between your age today and death. So somebody that's 35 with no health conditions, that's scenario number one. Scenario number two is someone that's 35, that maybe has had multiple shoulder surgeries and got in a car accident and had, a concussion, and or maybe they're diabetic or whatever. That person is obviously going to be charged more on their premium because statistically, or according to the actuaries, that person is closer to death or a higher risk. And so the higher the risk, the higher the premium. And so the qualification process is a little bit more in-depth than the questions on life insurance applications. If you've ever done a life insurance application, there's a series of questions that asks about, family history and cancer history and blood pressure and depression and height-weight ratios and all these different things. And then long-term care coverage launches into a whole new set of questions about if you've ever been confined to a facility, what surgeries you've had, have you fallen, all these different things that just go into a little bit more depth. And then a lot of the time requires what's called a PHI, or personal history interview, PHI, where the insurance company actually calls the individual and has like an over-the-phone interview to ask them further questions. And if they need further clarification, then they even order medical records. And that's the same with life or long-term care, but they can order medical records. Okay, so what happens is long-term care coverage is measured in two ways, and I kind of alluded to it a little bit earlier, is measured in two ways. Either a total benefit that can then be turned into a monthly payment, or the person pays the premium for the monthly benefit. So, for example, I get a long-term care policy. I pay, well, let's just, really look at the difference. There's standalone, and then there's adding it as a rider. So you have standalone long-term care, and then you have it as a rider. So standalone long-term care, it only covers long-term care. Only covers long-term care. This is usually going to be life insurance plus long-term care. Okay, so the premium that I pay here, let's say I get a standalone long-term care policy, and I want it to pay me if and when I need the long-term care. I want it to pay me $10,000 a month. You're like, why the heck would you want to pay you that much? Well, today, maybe I don't need $10,000 a month in a long-term care facility, but in 30 years, I would, because of inflation, etc. And the cost of some of these facilities is, some of them actually are $10,000, $15,000 a month, right? And so then my premium is calculated that way, where usually when it's a rider in a life insurance policy, it approaches more of the total benefit. And let's say that total benefit, life or long-term care, whichever is triggered, is $500,000. Okay, it's $500,000. I'll talk about why I chose these numbers in this example in just a second. And so what happens is, if this was my structure, I pay my premium until I need the coverage, and then when I qualify for coverage, then my premium stops. Okay, so let's say that I'm going through my life and I end up in I need long-term care. Well, what triggers needing long-term care? Well, it's something called the activities of daily living, or ADLs. Again, if you want to use acronyms and sound smart when you're talking to other insurance people. ADL stand for activities of daily living. If I cannot do 2 of the 6, that's what triggers the long-term care coverage, when I cannot do 2 of the 6. So what are the activities of daily living? Okay, let's just list those out just really quick over here. The activities of daily living are, the activities are feeding yourself, going to the bathroom on your own, being able to dress yourself, bathing yourself. So those are 2 different ones. Going to the bathroom. There's like some more scientific word that they use for that. Bathing yourself, being able to walk, or just everyday mobility. Everyday mobility, things like getting out of the bed into the wheelchair, stepping into the bath or the shower, things like that. So mobility. So the 6 ADLs are feed yourself, go to the bathroom, dress yourself, bathe yourself, be able to walk, and mobility. And then I've seen in some applications where they've it's not necessarily adding one, but I think it's just another way to test mobility, is whether you can brush your hair, which I guess I wouldn't have to worry about that one. But that doesn't qualify me here because I don't have hair. Anyway, sorry, that was a bad joke. Anyway, but brushing your hair or your teeth is one I've seen in some of them. So those are the 6 activities of daily living. So basically what happens is, as soon as I cannot do 2 of the 6 and get a doctor's note or whatever way to prove that, if I cannot do 2 of the 6, that's what triggers the long-term care rider be paid. So if I have a standalone long-term care policy, can't do 2 of the 6, then it starts paying me $10,000 a month for a specified period of time, depending on how much I bought in the standalone long-term care policy. 3 years, 5 years, 8 years, whatever, right? And obviously the more years I buy, the more the premium is going to be. Okay, so that's standalone. If it's a rider, how it works is as soon as I cannot do 2 of the 6 activities of daily living, it triggers the ability to use the long-term care rider. And what I'm able to do is, in most, I'm able to take as much as 2% per month of the total benefit. So if my total benefit is $500,000, I can take 2% of that, which is $10,000. I can take $10,000 of that per month until that benefit goes to 0. Okay, I don't have to take 2%. I can take 1, 1.5%, 2%, but usually the maximum is 2%. So as far as straight up cost for each, just for the long-term care portion, if I was to get a standalone long-term care policy, average, I've seen, of course, depending on age, depending on health, depending on a lot of things, I've seen anywhere from $200 all the way up to about $600 a month as a quote for a standalone long-term care premium on a policy. But of course, that's going to depend on age and health and all of those factors. Where the long-term care rider is going to be more in the range of like $20 to maybe $50 or $80 a month as a rider. Now, remember, if, people look at that and they're like, well, gosh, obviously everyone's going to do this one. Well, that's only, of course, if they need the other coverage that this is added to. So riders can only be added to policies that currently exist. So if I have no need for life insurance, let's say, at all, and that's going to cost, several $100s or something to get the life insurance, and that's why I'm buying it because long-term care is less expensive, well, the overall cost might be more for life and long-term care than it is for just long-term care alone. But that's what doing a needs analysis is for, is to see what the need is. Because the positive side to both is that, there's that 70% chance that somebody ends up in a long-term care facility, and if I have the coverage, well, then I'm covered. The downside is that the standalone long-term care policy is if I never end up in a long-term care facility, then that premium just went to nothing. Well, kind of like car insurance. If I never get in a wreck, all those premiums just kind of go to nothing, where in standalone long-term care, as in all insurances, it's the same way. If I never need the coverage, then I was just paying for comfort, really, is all I was paying for. But we know that people spend millions of dollars on things to create comfort, right? Where in a policy where it's more of a rider approach, is that it answers now 2 what-ifs, because if I do need long-term care, I can use it for long-term care, but if I don't need it for long-term care and I die prematurely, or I just don't end up needing long-term care or in-home care, then it acts as a death benefit for life insurance. And the cost of it was a little bit lower. And then, like I said, on the Social Security Administration's website, or at least it did, is the Social Security Administration's website says that the least expensive way to purchase long-term care insurance is as a rider on a life insurance policy. So that is our lesson for today. So thank you for joining us on the Impact School of Money today. Today was lesson 28. And, one of the things I'm going to be challenging everybody to do, or asking everybody to do on every episode, for every episode that you watch, I want you to tell a friend or listen for when this topic comes up. Tell them that you watched something called the Impact School of Money and how you learned about insurance or long-term care or whatever. Just pick something and tell them to jump on. And then we'll ask them to do the same thing. And that's all we ask is, we don't charge for this. We're never going to charge for it. We're not going to put a bunch of ads on it. This is something that we're just going to offer as a free class that people can come and learn and get money principles from people that have experience in the industry. Just copy and paste that link. Email it to them or text it to them. The Impact School of Money will be the way that people learn about money. Thank you again for joining us today on the Impact School of Money. Class dismissed.